Please come to in IAS 12, paragraph number 6, tax base of an asset or a liability. Now, this is very important for this chapter. If you can calculate this figure correct, almost your task is done. Carrying amount you can easily get from books of account. Tax base of an asset or liability is the amount attributable to that asset or liability for tax purposes. That is, how much amount you will attribute it for tax purpose. But more important is how do you compute it. This standard has defined tax base for asset and liability, which means it has not defined the tax base for equity items. Okay. So that we'll discuss at the end. What if there is no equity, tax base of equity? So tax base of, first we'll learn how to calculate asset, then we'll learn tax base for liability, and then we'll learn item not recognized as asset or liability. That means in the last case, carrying amount is 0. Carrying amount in the books is 0, but still it can have tax base. Tax base is yes, possible. Like for example, preliminary expenditure written off. Carrying amount is 0, but under Income Tax Act deduction may be allowed in 5 installments, so it will have tax base. Research expenditure may be written off, but maybe in some tax jurisdiction research expenditure is allowed in installments. VRS expenditure you may write off, but VRS expenditure may be allowed in installments. So these are situations when you don't have carrying amount but you have tax base. Now to simplify, we will understand tax base of an asset related to two types of situation. Tax base of an asset related to when economic benefits are taxable and when economic benefits are not taxable. When economic benefits are taxable, for example, property, plant, equipment, when you use them you generate profit. Or inventory, when you sell them you generate income. Or say for example, interest receivable, rent receivable, these are economic benefits are taxable. And economic benefits are not taxable means, for example, debtors. When you collect money from debtor, is there any tax consequence? Usually no. Loan received, any tax consequence? No. So these are those items which do not have tax consequence. So if you can identify where do we belong, first you will understand it is an asset. At least this much we can understand. And after understanding that yes, this is an asset, we can identify whether it relates to expense or income. For example, property, plant and equipment, it relates to which item? Expense or income? Expense, because you are going to depreciate it or you are going to sell it. If you are going to sell it, then that amount will be deducted from sale value in calculation of your tax liability. Or same example, inventory, related to expense, but interest receivable is related to income. Rent receivable is related to income. So what I'll do, if I get an asset, I will first identify whether it relates to an expense item, income item, or a not taxable item. That much we can do. And after that, I'm going to now tell you how to get the tax base in these three situations. Okay. First is when economic benefits are taxable related to asset. Under that scenario 1, economic benefits are taxable, which means whenever you will recover the carrying amount of this asset in future, this event will have a tax consequence. And then whenever you recover the carrying amount of this asset, it may be an expense item or it may be an income item. Like in case of property, plant, equipment, how do we recover the carrying amount? By providing depreciation. So that is an expense. In case of inventory, it is a cost of goods sold. So that is an expense. So tax base of an asset is equal to the amount that will be deductible for tax purpose against any taxable economic benefit that will flow to the entity when it recovers the carrying amount of the asset. So what is the tax base? Tax base is the amount that will be allowed as deduction. Tax base is the amount that will be allowed as deduction in future against taxable income. This is the easiest thing. Tax base of an asset is the amount that you will be allowed as deduction in future if it relates to expense. Like for example, complete that question. Cost of an asset is 1 lakh and you have provided depreciation of 25,000 in this year. Now what is the tax base of the asset after charging depreciation under tax law? So write down the answer will be 75,000. Because next year or in subsequent year, you will allowed a deduction of rupees 75,000. You will be allowed a deduction of rupees 75,000. Okay. Written? Write down, because this is a very fundamental chapter and it will be required for many other chapters. In all other chapters, wherever the deferred tax adjustment will come, you have to refer this chapter. So in the books of ASF Limited, one more practice, an amount of rupees 25,000 is recorded as rent paid in advance. For income tax purpose, the amount is deductible on accrual basis. The amount is deductible on accrual basis. Determine the tax base of the asset. Rent paid in advance is an asset or a liability? So first it is an asset. Whether it relates to expense or income, it relates to income. Now once you have reached this point, now we have to answer the tax base will be that amount that will be allowed as a deduction in future. Is it right? So tell me how much amount will be allowed as deduction in future. For income tax purpose, the amount is deductible on accrual basis. So next year when I will pass the entry, what entry will I pass? Rent account debit to prepaid rent. I will be allowed as a deduction in the next year. So what is my tax base? 0 or 25,000? Come on. Tax base is the amount that will be allowed in future. 25,000. So write down the answer is 25,000, because next year you will get 25,000 rupees deduction while calculating your income tax liability. Next is when economic benefits are taxable. Example, if you keep the example in mind, it is easy. Like interest receivable. Interest receivable is an asset and it relates to income. Rent receivable, it is related to income. Dividend receivable, it is related to income and it is an asset. So in this case, tax base will be equal to, tax base is the amount that will not be taxed, that will not be taxable when it recovers the carrying amount of the asset. So little confusing. After reading liability, it will become more confusing. Tax base is the amount that will not be taxable when it recovers the carrying amount of the asset. So what amount will not be taxed in future when we recover the carrying amount of the asset? Amount not taxable. Underline this much. And then with example, I'll tell you a logic. And once you understand the logic, you will not go wrong. But some knowledge of Income Tax Act is required today, which I don't have, but you must be having definitely. Yes or no? No, more than me at least. Assume that interest receivable is 100 rupees. So what I have to keep in mind, the tax base is amount not taxable in future. In books of account, we will always assume accrual method is followed. In books of account, what we will assume? Unless otherwise specifically given, we will assume accrual method will be followed. So assume that interest receivable is rupees 100 in the books. Now what entry they have already passed in the books of account? In the books of account, they have passed the entry. You must know some basic accounting entry and some basic tax law. Then this chapter I can handle. Interest receivable to interest income. This is the entry they have passed. Such interest is taxed on cash basis. Means this item is not offered for taxation in the current year because it is receivable. So now in future it will have tax consequence. The moment you receive the interest, it will be subject to tax. So how much amount is not taxable in future? Entire amount is taxable in future. If entire amount is taxable in future means zero amount is not taxable in future. So can I say tax base is zero? Tax base is zero. 100% amount is taxable in future. So when benefits flow to the entity realized in cash, it will be subject to tax. So under tax law, it will be subject to tax in the next year. So when you will receive the amount, bank account debit to interest receivable, it will be taxed. It means there is a difference between what we will get in books of account and what we'll get for tax purpose. The treatment of this item is getting different for accounting purpose and tax purpose. 100 rupees will be taxed in the subsequent year. Is it right? So the answer would be 0. Tax base will be 0. Any uncollectible income, right? Oh, that is written. Like interest receivable, if taxed on a cash basis, has a nil tax base. In fact, you can generalize this. Any uncollectible income, if taxed on cash basis, will have 0 tax base because it will be taxed in future. So since it will be taxed in future, it will have a 0 tax base. Right now it doesn't have tax base, as it will be added in full to the future taxable income. One more way we can understand this thing, but be very careful when you use this other method. How much amount I have offered for income in the books of account? In the books of account, I have offered 100 rupees as income. How much income I have offered for tax purpose? I have offered for tax purpose 0. That means there is a difference in the treatment for accounting purpose and tax purpose by 100 rupees. Is it right? Now, if you can imagine these two things, that in books I have treated 100 rupees as income, for tax I have given 0 rupees treatment, which means there is a difference between my treatment in books and tax 100 rupees. Now do reverse working under this standard. Under this standard, carrying amount is 100 rupees. Difference is 100 rupees. If carrying amount is 100 and difference is 100, so what will be the tax base? Tax base equation is carrying amount minus tax base is equal to difference. Carrying amount minus tax base equal to difference. So if difference itself is 100, the tax base has to be 0. This is called income and expense way to identify the difference. Is it right? The answer will always match. If you can understand through this way, logic is same. The logic of these two is same, whatever you try to understand. In this case, the tax base of interest receivable is right 0, as the amount not taxable in future is 0. Have you written? It has a nil tax base. Just write down nil tax base. That is enough. In this case, tax base of interest receivable is 0. Is 0, right? Is 0. This much you have to write in your answer sheet. Tax base of interest receivable is rupees 0. Okay, one more question. Assume that the interest receivable is rupees 10,000. Means you have shown 10,000 rupees as income in the books of account. So carrying amount is 0. Rupees 6,500 will be claimed as non-taxable. Will be claimed as non-taxable, and balance is taxable. So first of all, is interest receivable an asset? Yes. Is it related to income? Yes. So tax base will be amount that will not be taxed in future. How much amount will not be taxed in future? 6,500 will not be taxed in future. Only 3,500 will be taxed in future. So therefore, write down the tax base of interest receivable is 6,500. Answer, write down. Amount not taxable in future is rupees 6,500. So automatically the difference of 3,500 will come. And on that 3,500 we will create a deferred tax. Now we'll come to when economic benefits are not taxable. It is an asset item, but when we recover the carrying amount of that asset, it will have no tax consequence. If it has no tax consequence, it means I don't have to show a difference. And if I don't have to show a difference, the tax base must be equal to carrying amount, like loan receivable, debtors. One more example, dividend receivable but not taxed in future. Okay, exempt from tax. It does not have a tax consequence. ESF Limited recorded dividend of rupees 25,000 receivable from its subsidiary. The dividend is exempt from tax. So rupees 25,000 is not taxable in future. Can I say that? Entire 25,000 is not taxable in future. So determine the tax base of the asset. The answer is 25,000. You can either apply the previous paragraph. Since it is an income, the tax base will be amount that will not be taxed in future. 25,000 rupees entire amount is exempt from tax. So therefore, the tax base will also be 25,000. Or you can say for those items for which we don't have future tax consequence, will be same as carrying amount. As rupees 25,000 as dividend will never be taxable. Now one more example we'll take. Question number 6. Trade receivable is rupees 120. Being an asset in statement of financial position is realized in full. The economic benefit receivable from the said asset is already included in the taxable profit when the sales had occurred. On realization, the amount of benefit, on realization of the amount, the benefit, that is cash inflow, are not taxable. Determine the tax base of the asset. Same answer write down. Any asset which has no tax consequence has the carrying amount as its tax base. Answer. Therefore, tax base of the asset is equal to carrying amount is equal to 120. Okay. One more chance. Is this question printed somewhere below? Just see. Somewhere below. Question number 9. A Limited has a bank balance of rupees 10,000. Cash balance, bank balance, debtor. Determine the tax base. It is an asset. Does it have a future tax consequence? No. So the answer is copy paste previous answer. Any asset which has no tax consequence has carrying amount as its tax base. Has carrying amount as its tax base. Therefore, tax base of asset is equal to carrying amount is equal to rupees 10,000. Is equal to rupees 10,000. First, we'll understand the fundamental, because while solving the problem, it has to be very clear, very quick, that it is the tax base is this amount. Then only you can proceed further. Question number 7. What is the tax base of the inventory? Carrying amount. Same amount is allowed for tax purpose also. Is it right? So if you have 1 lakh rupees inventory, for income tax purpose also, the carrying amount will be equal to, tax base will be equal to carrying amount. Don't write, I have written in your notes. By definition, the tax base of the asset is the amount that will be deductible for tax purpose. So we are done in point number 1. Asset, first category. Expense category. So for expense category, the tax base is the amount that is allowed as deduction for tax purpose. In this case, recovery of the asset implies consumption or sale. The carrying amount of the inventory is charged against revenue when consumed or sold in full. So the tax base is equal to carrying amount, and therefore there will not be any temporary difference. Next question is, what is the tax base of asset which are carried at fair value? Okay. Now here one has to see what is the treatment for tax purposes. Will tax law also allowed fair value of the asset or no? And accordingly my answer will change here. So case number 1, these are the example which we will require while solving some bigger question. Depreciable asset carried at fair value. So depreciable asset carried at fair value, like under IAS 16, property, plant, equipment carried at fair value, revalued amount. But fair value is not allowed for charging depreciation for tax purpose, which is what is normally the case in most of the countries. So in this case, the carrying amount will be the fair value, but the tax base will be based on original cost minus tax depreciation provided till date. Is it right? You will also assume this thing. When a question like this comes in the exam, you will assume this only. Unless they specifically mention that tax law also allow fair value. So case number 2, depreciable asset carried at fair value, but fair value is allowed for charging depreciation for tax purpose. For this example, depreciation and amortization are same. So in this case, since your tax base is also allowed to be revalued, the carrying amount is the tax base. But this is, to my knowledge, limited knowledge of income tax is not allowed. Is it allowed? Not even one example. At least we don't know. You don't know, I also don't know. I will ask some tax consultant. Till that time we know, we will assume this is not possible in India. Okay. You will assume case 1. Third is financial asset. This will give rise to another challenge in future in many countries, because in books of account you are carrying financial asset at fair value. You will increase the value, decrease the value, both. But fair value is not allowed for tax purpose. Fair value gain or fair value loss, both are disallowed for tax purpose. So in this case, the carrying amount will be fair value, but the tax base is the original cost. Underline next line. In case indexation is allowed, in case indexation is allowed, like for example, for long-term capital asset, in India, income tax act says there are 2 types of capital asset, long-term and short-term. On long-term capital asset, you can do indexation. You can increase the value of the asset by multiplying by current year index and dividing by index of the year of purchase. So this artificially increases the value. So that amount will become the tax base in case indexation is allowed. Dear student, solve one question. E Limited has stock at fair value in the SOFP at rupees 1000. Fair value in SOFP is 1000, whose cost is rupees 800. What is the tax base? So write down tax base is rupees 800. Now here stock means maybe financial asset stock, not the inventory. Because in inventory, it will not be allowed to increase your value above the cost. So maybe this is a financial asset which are carried at fair value. One more chance. An entity has an investment in listed equity shares. There is no tax on gains that arise on sale of this listed equity share. There is no tax on gains that arise on sale of this listed equity shares. What is the tax base of the asset? If it has no tax consequence, then the tax base will be equal to carrying amount. Tax base will be equal to carrying amount of the investment. So for asset, we will revise the 3 lines again. In case of asset, if future economic benefits have tax consequence and it will result into an expense, tax base is the amount that will be allowed as deduction. It is an asset, it has an economic consequence, economic tax consequence in future relating to income item. Tax base is the amount that will not be taxed in future. And the third is, it is an asset but it has no future tax consequence. Then carrying amount is equal to tax base, like this example. Okay. And then we have tax base of a liability. Here in the books, the liability side has those liabilities which have which are related to expense, and there are those liabilities which relates to income received in advance. Liability comes in our SOFP for two reasons. Either it is an expense which I have to pay, or it is an income which I have received in advance. Expense, stipend payable. Yes or no? Rent received in advance is an income. Expense, provision for gratuity, rent payable, provision for warranty, interest received in advance, right? Some examples I have written. What about the carrying amount? Carrying amount is this amount which is appearing in your SOFP. What about their respective tax bases? So first of all, when I read a question, I have to check whether it is an asset or a liability. Liability. Whether it relates to an expense which is payable or an income which is received in advance. Because the tax treatment vary from jurisdiction to jurisdiction. Like in this example, stipend payable will be allowed as an expense under tax law. But provision for gratuity, which is also an expense related to expense, is not allowed. Rent payable is allowed as an expense, but provision for warranty may not be allowed as an expense. Rent received in advance may be taxed on cash basis, maybe in some cases, but interest received in advance will be taxed in the future year to which it relates. So because the tax treatment can vary from book treatment, it may give rise to difference. Okay. So very simple, what I'll do, close my eye and see what will be its impact in the income tax. If the treatment is same in the income tax also, tax base will be same. If the treatment is different in the income tax law, it will have some tax base. First you understand from that point of view. In this chapter for everything, is the treatment same for income tax? Does income tax also consider same amount of income and same amount of expense? If the answer is yes, tax consequence is 0, tax base is equal to carrying amount. Not tax base is 0, tax base becomes equal to carrying amount. Like for stipend payable, even though you don't know the chapter, because its treatment is same, its carrying amount and tax base will be the same. But for provision for warranty, as you know, entire warranty provision will be disallowed. That means whatever you have written in books of account as provision for warranty is also the difference. If the same amount is difference, it means its tax base will be 0. Right? So that is my strategy to identify the tax base. Anyway, we'll go as per the standard. For expenses, the tax base is the of a liability is the carrying amount minus the amount that will be deductible for tax purposes in respect of that liability in future period. What is the tax base of a liability which is related to expense? So formula is CA minus amount deductible in future. This is the minimum words I can use for this tax base of a liability related to expense. Carrying amount minus amount deductible in future. Say for example, stipend payable. Stipend payable, how much is your stipend? 40,000, my God, unbelievable. 40,000 is the stipend. This is already deducted for tax purpose. So amount that will be deducted in future is 0. So tax base of your stipend payable is also 40,000. Right. Provision for warranty. Suppose provision for warranty is 40,000, but it is disallowed for income tax. In future, when you will incur the expense, that time it will be allowed as deduction. So tax base of provisions, in this example, provision for liability, provision for gratuity, provision for this and that, since they are disallowed for income tax purpose, they will be allowed in future. Normally the carrying amount is normally the tax base is 0. As simple as this. Solve one example. For every line we'll have 1 or 2 examples. Some knowledge of income tax is useful. Consider the case of provision of rupees 2 lakh towards bonus. Such expenditure towards bonus is tax deductible. Only on payment of that liability when the bonus payable is actually paid. Being subject to section 43B of Income Tax Act India 1961. What is the tax base? Carrying amount is 2 lakh rupees. Entire 2 lakh will be allowed as deduction in future. So right now its carrying amount is tax base is nil. So write the answer. The tax base is nil. You want to write explanation? In bracket write. Carrying amount of rupees 2 lakh less tax deductible expenditure in future rupees 2 lakh. Okay. Again I will give you a trick. Use your trick in case if you have some confusion, some doubt. How much amount is shown as expense in the books of account? 2 lakh. You will pass an entry, bonus expense account debit to provision for bonus account. But this amount is disallowed in the income tax, which means the difference between what we have done for accounting purpose and for tax purpose is 2 lakh. In books expenditure is 2 lakh, but for tax the expenditure is 0, which means there is a difference of 2 lakh rupees between the treatment given in book and the treatment given for tax purpose. If my difference is 2 lakh, this minus this should be equal to 2 lakh. So therefore the tax base has to be 0. Okay. This is income and expense way to identify the tax base. It works. Okay. Because somebody may be used to this method. Logic is same, only the IFRS uses asset and liability route. But the same thing can also be understood with the help of income and expense route. Okay. Income give rise to asset, expense give rise to liability. Dear student, continue. Solve the next question. A company has made provision for warranty cost of rupees 10,000 in its account. Same question. Earlier it was provision for bonus, now it is provision for warranty. Tax laws do not permit deduction until the company actually pays the claim. Fill in the blanks. Tax base equal to. Tax base is equal to 0 or 10,000. Think and answer. In books of account, 10,000 rupees expense I have claimed. But for tax purpose, it is not allowed. This will be allowed in future. Okay, whenever the company actually pays the claim, then the answer is 0. carrying amount minus amount deductible in future. So the answer is 10,000 minus 10,000 equal to 0. Now we'll come to tax base of a liability for income received in advance. Income received in advance, example, rent received in advance. So till it accrues, it is not my income. Interest received in advance. The tax base of the liability is its carrying amount minus the amount of revenue that will not be taxable against that item in future. For income received in advance, carrying amount minus amount not taxable minus not taxable in future. Minus not taxable in future. We'll take one small example. Same example I wanted to explain. Suppose rent received is 10,000. Rent received in advance is 10,000. Already taxed on receipt basis. Already taxed on receipt basis. Now first you understand in the books of account what entry I have passed. Entry for rent received in advance. Bank account debit to rent received in advance. Correct? 10,000, 10,000. So is it offered for income in the books of account? Have I shown it as income? No. It is not shown as income in books of account. Not shown as income. I am going very slow, I know, but a lot of students need to understand the basics. Okay. Not shown as income in the books of account. But what you have done in the tax book? You have treated it as an income. You have already treated it as an income. Already taxed on receipt basis. Will this amount be taxed again in future? Will you offer it for tax again next time when you pass the entry in the books of account, rent received in advance account debit to rent income? No. So next year you will show it as income in books, but it won't be shown as an income again for tax purpose, which means there must be a difference. Here I am showing zero income in the book and I am showing 10,000 rupees income for tax purpose. So there must be a difference of 10,000 rupees between my carrying amount and my tax base. How to create the difference of 10,000? 10,000 is carrying amount. I need a difference of 10,000 rupees. So what should be the tax base? 0. So what the standard setter has done, he has used the same logic and he has just converted it into a formula. That is this figure, tax base equal to carrying amount minus the amount that will not be taxed in future. So 10,000, write down, minus 10,000 is equal to 0. Okay. If you can't remember the formula, remember this small income tax treatment. It is treated as 0 income in the books. It is treated as 10,000 income for tax purpose. Therefore, I need a difference of 10,000. Is it right? The differential treatment is 10,000. So carrying amount is 10,000 minus tax base should be equal to 10,000. So tax base balancing figure 0. That is one more way to get the answer. Okay, now some more items we will discuss. In the case of future revenue, which is received in advance, revenue received in advance, same example, rent received in advance, but will be taxed in future on accrual basis. So it has no deferred tax implication now, no tax consequence now. it will be shown as income in books and as an income for tax purpose in the same year. So the answer is its tax base will be equal to carrying amount. If I apply the same formula, tax base is equal to carrying amount minus amount of revenue that will not be taxed in future. So now this time my answer for this question will be 10,000 minus 0. Answer will be 10,000. Tax base will be 10,000 because entire amount is taxable in future. Example. Advance received for supply of goods and service has tax base equal to carrying amount as those advances are taxed on accrual basis. Another example of liability, an outstanding expense that is not deductible in computing tax profit. An outstanding expense that is not deductible in computing tax profit has a tax base to the extent it is not deductible for tax purpose. Say for example, current liability include fine and penalty with a carrying amount of 10,000, and assuming that this fine and penalty is not deductible in future, amount not to be deducted in future. So what is the formula we have learned earlier for tax base of a liability relating to expense? It is the carrying amount minus amount that will be deductible for future. So here 0 amount is deductible for future. 10,000 minus 0, 10,000. Or you can say in a simple terms, for such item, tax base is equal to carrying amount. Tax base is equal to carrying amount if that outstanding expense cannot be deducted in future. One more easy example. If a liability represents an outstanding expense that is taxed on cash basis, then its tax base is nil. This is again similar to one example we have solved, question number 15. Is it right? Which was rent received in advance. So any liability which is already taxed on cash basis, its tax base will be nil. Like this example, outstanding contribution to employee provident fund is rupees 1 lakh. Carrying amount of the liability is 1 lakh. Amount to be deducted from future taxable income is rupees 1 lakh. So therefore, carrying amount is nil. By this example, so I think the example is mismatching. This example, write down refer example, question number 15. But question number 15 is income received in advance. Wait. Don't write example 15. This is okay. Outstanding contribution to employee provident fund is 1 million. So for accounting purpose, the liability is 1 million, but will be deducted in future when you actually pay it. So amount to be deducted from future tax income 1 million. Carrying amount is a tax basis nil. A liability having no tax consequence has the carrying amount equal to its tax base. Okay. Assuming it has no material transaction cost. Okay, this you remove. This is the simplest example. Suppose loan is appearing in the balance sheet as 10 million. When you settle the loan, there is no tax consequence. When you settle the loan, there is no tax consequence. So therefore, tax base will also be equal to 0. Another example is trade payable. Trade payable. Its tax base is equal to carrying amount. Or stipend payable. tax base is equal to carrying amount. All such liabilities which do not have future tax consequence, which means both of them it has been accounted under books and for tax purpose on accrual basis, then it has no further tax consequence. Now question number 16, 17, 18. First you try all the three problems and then I will check. Number 16. Current liabilities include accrued expenses with a carrying amount of rupees 100. The related expense will be deducted for tax purpose on cash basis. What is the tax base? Is it a liability? Yes. Is it related to expense? Yes. Tax base is carrying amount minus amount that will be deductible in future. 100 minus amount that will be deductible 100. So what is the answer? 100 minus 100. Write down 0. Formula write down. Write 2-3 times formula, you will be able to remember. Tax base is carrying amount minus amount deductible in future. 100 minus 100. Therefore, tax base is nil. Okay, those who have done, kindly go to next question. Current liabilities include accrued expense with a carrying amount of 100. The related expense has already been deducted for tax purpose. That means it has no future tax consequence. If it has no future tax consequence, carrying amount is equal to tax base. So write down the answer. Tax base is equal to carrying amount equal to rupees 100. If both in the books and for tax purpose expenses are considered on accrual basis, then tax base and carrying amount will be equal. Try one more. Current liabilities include interest revenue received in advance, income received in advance with a carrying amount of rupees 100. The related interest revenue was taxed on cash basis. What is the tax base? Tax base equal to carrying amount minus amount. No, it is income. Related to income received in advance. The formula is minus amount not to be taxed again in future. For income, the formula will change slightly because it is interest revenue received in advance. They have already taxed on cash basis. So if you have already taxed on cash basis, amount not to be taxed in future is 100 rupees. So the answer will be 100 minus 100. 100 minus 100. 0. Tax base is the interest received in advance is nil. Okay. This also I have written a general statement somewhere below. In case of future revenue which is received in advance and taxed on cash basis, its carrying amount, its tax base is always nil. Okay. Or you can apply the formula 100 minus 100, 0. Have we completed all the three examples? 16, 17, 18? Say yes or no. Only? Okay, Next is items not recognized as asset or liability. This is a situation where carrying amount is 0, but it can have a tax consequence. Therefore, for such item, there will be a tax base. Example, in India, under Income Tax Act, preliminary expenditure incurred to form a company in the beginning is allowed as one fifth over 5 years for tax purpose. For accounting purpose, it is 100% write off in the first year. Okay, under IAS 38. So now its carrying amount is 0, but it will have a future tax benefit. 1/5 you will get in this year, remaining 4/5 you will get in future year as a benefit under the tax law. So it will have a tax base. Solve this example. ASF Limited incurred research cost of 5,000. Amount is charged to P&L account. For tax purpose, the deduction is permitted only after satisfying certain conditions. So the question would be, what is the tax base? Carrying amount is nil. Carrying amount is nil because the amount has been written off. So tax base of the asset will be 5,000. Amount deductible in future is rupees 5,000. Amount deductible in future will be rupees 5,000. Therefore, rupees 5,000 will be the tax base. 5,000 rupees will be the tax base. One more question. A Limited has been incorporated recently. It incurred rupees 1 lakh on its incorporation. It has been charged to revenue in the very first accounting period. The taxation laws allow deduction over a period of 5 years. Carrying amount at the end of year 1 means book value is nil. What is the tax base? Will it have tax base? Carrying amount is nil. Yes. 4/5 of the amount will be the tax base because in the first year 1/5 will be written off. 4/5 will be written off in future period. 4/5 of 1 lakh, that is 80,000, will be the carrying amount, will be tax base. Answer write down, tax base will be rupees 80,000. That is 4/5 of rupees 1 lakh. As rupees 20,000 being 1/5 is allowable as a deduction in taxation laws over 4 years. Over 5 years, right? Write neatly. Written neatly. 1/5 will be allowed as deduction in taxation law each year over 5-year period. 1 year is over. So 1 year we have written off 20,000 for tax purpose. Remaining 80,000 we will write off in future. So after understanding tax base of asset and liability. Tax base of asset, first, it has an economic tax consequence. It is related to expense. Formula. Amount that will be allowed as deduction in future. It is related to income. Amount that will not be taxed in future. It has no tax consequence. Carrying amount is equal to tax base. Then liability. Related to expense. Tax base equal to carrying amount minus amount that will be deductible for tax purpose in future. It is a liability related to income. Carrying amount minus amount that will not be taxed in future. Okay? And if carrying amount is 0, sometime it can have a tax consequence and therefore we will compute the tax base. Okay? Even if that item is not appearing in the books of account as asset or liability. Okay. Now, if the tax base of asset or liability is different from carrying amount, then only the standard comes into play. Tax base of asset or liability is different from carrying amount. Then we have to compute what is called deferred tax. This difference is called temporary difference. If there is a difference between tax base and carrying amount, the difference is called temporary difference, because the difference will go away in future. Hence temporary difference. Temporary difference is the difference between CA of an asset or liability minus tax base. These differences are of two types. Taxable temporary difference, in short TTD. Deductible temporary difference, in short DTD. So in this chapter we will write, if I want to write TTD, DTD. Now what is the meaning of taxable temporary difference? Taxable temporary difference means taxable. These are those temporary differences which will be taxed in future, taxable in future. Can I call it taxable in future temporary difference? Then it becomes easy to understand. Taxable means, will it give rise to an asset or a liability? Liability. It will give rise to a liability because this difference will be taxed in future. Taxable temporary difference that will result in taxable amount determining taxable profit or tax loss of future period when the carrying amount of the asset or liability is recovered or settled. So whenever the asset or liability will be recovered or settled, it will give rise to more tax liability. It will give rise to tax liability. So this results in higher taxable profit in future. Because of these differences, more tax liability arise in future. For example, in books of account, an asset purchased for 1 lakh, depreciation charge 20,000, carrying amount is 80,000. And you have written off that depreciation asset 100% in the first year for tax purpose. Now what will happen next year? When I will provide 1/5 depreciation in books, I will not get any depreciation for income tax purpose. So I have recovered 20,000 rupees of an asset, and correspondingly we are not getting any tax benefit. It means I have to pay more tax in the future period. So therefore this results into higher taxable profit in future. Then student is wondering what these two emojis are doing here. He is happy right now. Why? Why you are happy? Because I am saving tax now. I am saving tax now. I am such a difference which helps me to save tax. So now I am happy. But then why you are crying? Because I have to pay more tax in future. So in bracket I have written for you. What I have written for you? Save now, tax later, pay later. Okay. Now these are certain just tricks to handle a confusion situation. Sometimes the student may be confused that whether it is a taxable difference or deductible difference. And being a good student of income tax, just think, will it result into saving now and paying more tax in future? If the answer is yes, then that difference is a taxable temporary difference. Okay. Taxable temporary difference can arise on the asset side also or on the liability side also. Mostly it will come due to asset side item. Asset side, when the carrying amount of an asset is greater than its tax base. Books is showing more value, but tax base is low. It means you will get less tax deduction in future whenever you recover the carrying amount of that asset. Is it right? Like it happens for property, plant, equipment, that you know. So I am taking that example. We purchased a property, plant, equipment for 1 lakh. Our depreciation rate is 10%. So 90,000 is the carrying amount. But for tax purpose, depreciation rate is 15%. So my carrying amount is now 85,000, which means in future, when I will recover the carrying amount of the asset, I will get less tax benefit in future, because income tax law would allow me only up to 85,000 rupees deduction, which means I have to pay more tax in future. 5,000 rupees into tax rate more I have to pay in future. Liability side, when the tax base of a liability exceeds its carrying amount. This is a very rare situation. Okay. Right, rare situation. So today as a homework you will go and find out under which situation of income tax law, if you know, where the tax base of the liability exceeds the carrying amount. I have two formula for tax base of a liability. First formula was carrying amount minus amount deductible in future if it is an expense related item. And my second formula is carrying amount minus amount not to be taxed in future. This is for income received in advance. Correct? Income received in advance. And this is for expense. This is for expense. Correct? But if I am using a minus sign, it means my tax base would be lower or equal. The tax base can be more only if this is negative. That means more amount is deductible in future, or more amount will not be taxed in future. So there are one or two provisions in the Income Tax Act where this is possible. Don't know. Okay. So you have to find out. Not a normal provision. 43B. 43B is carrying amount minus amount deductible in future. So this figure will be lower. Tax base will be lower. Even if there is a zero amount, it will be equal, but it can't be more under 43B. Okay, you will try. There are some situations when accelerated expenses are allowed. Which expense? Accelerated expense. More expense are allowed than what you actually incur, huh? Depreciation. But that is not a liability. Okay. So if there are taxable temporary difference, then it give rise to deferred tax liability. So how do you compute deferred tax liability? It is taxable temporary difference multiplied by tax rate, or the amount of income tax payable in future period in respect of taxable temporary difference. That is how much amount of additional tax liability you will pay in future because of this difference. That is called deferred tax liability, DTL. So in this chapter I will use this short form DTL. Deferred tax liability is TTD into tax rate. Tax rate applicable for future period if enacted or substantively enacted. If I know what tax rate is applicable to future period, that rate I will take, because deferred tax liability is the amount of income tax payable in future period. So the standard says it is better you take the next year tax rate if that is known at the end of the reporting period. Of course, if it is not available, then you take the tax rate applicable for that particular financial year only. Now next is question answer session will start. So TTD you understood, deferred tax liability you understood. Today as a homework practice again whatever we have discussed. The original cost of an asset is rupees 1 lakh and carrying amount is 50,000. So this is related to asset. In case of asset, DTL will arise when carrying amount is more than tax base. For income tax purpose, the depreciation is 60,000. Tax rate is 30%. So first of all, you have to see what is carrying amount and what is tax base. CA is 50,000. TB is 40,000. 1 lakh minus 60,000. So TTD, why TTD? Because carrying amount is more, 10,000. Is right? So what is deferred tax liability if tax rate is 30%? The deferred tax liability will be 30% of 10,000, 3,000. Here we have written the explanation. In the exam, you just have to write 30% of in bracket 50,000 minus 40,000. Okay, now your chance. Next question. The cost of an asset is 1 lakh. Accounting depreciation is 16,000. Tax depreciation is 25,000. Tax rate is 30%. My question is, what is DTA or DTL? In the exam, they will ask you what is DTA or DTL. So first of all, we need to check what is carrying amount. Write down there carrying amount is 84,000. Then write down tax base. Write down 75,000. Then check whether it is TTD or DTD. TTD 94,000. Then check DTL 30% of 9,000. 2,700. Done. Now it looks simple. Okay, try this one. Interest receivable has a carrying amount of rupees 100. Related revenue will be taxed on cash basis. Tax rate is 30%. Calculate DTA or DTL. Calculate DTA or DTL. So first you have to answer following two simple questions. What is carrying amount? 100. Right, 100. What is tax base? Now this is an asset and this is having a tax consequence in future. So therefore the tax base will be the amount that will not be taxed in future. How much amount will not be taxed in future? 0. Entire amount is taxable in future. So now write down taxable temporary difference 100. DTL 30% of 100. Is it 30 rupees? Say yes. Yes. One more question. Land was acquired for rupees 100. It was revalued at 150. The cost of the land for balance sheet purpose was rupees 120. For tax purpose, write down the cost of the land for tax purpose. For tax purpose was rupees 120 due to indexation of the cost. Due to indexation of the cost. Now question is tax rate is 30%. Find out the DTA or DTL. So first write down carrying amount 150. Tax base will be after considering indexation. That is 120, amount that will be deducted against future income. And then taxable temporary difference, TTD, 30. Next line. This will give rise to DTL of 30% of 30. Is it 9? Is it 9? Okay. Dear student, now we'll solve this question. An important question on your way. Carrying amount of a financial asset is 12 lakh. As per tax law, deduction will be allowed on indexed basis. Current year index is 282. Index was 246 when the asset was acquired. Cost of asset was 10 lakh. Tax rate 30%. Tax rate on long-term capital gain is 20%. Pass journal entry assuming FVTPL. What is FVTPL? Fair value through profit and loss account. FVTOCI. Fair value through other comprehensive income. But in this question, first I need to find out tax base of the asset. Then I need to find out the TTD and then DTL. Which rate you will apply for calculating DTL? Are you going to apply 30% or are you going to apply 20%? 20%, because this is a long-term asset, because they have given you indexation. So we'll apply 20%, no use of that 30% in our answer. So first we write down step 1, calculation of TTD and DTL. Calculation of TTD and DTL. First write down tax base in bracket 10 lakh into 282 current year index divided by 246 base year index is 1146341. Just check. Carrying amount 12 lakh. TTD write down C equal to B minus A. B minus A. 53,659. DTL is 20%. This rate will be rate applicable for long-term capital gain. Long-term LTCG. Because you are using indexation, means it is a long-term capital gain. And then write down journal entry. If it is an FVTPL item, the deferred tax will be recognized in P&L account. And if it is an FVT OCI item, the deferred tax will be recognized in other comprehensive income. Okay. So write down journal entry case 1 FVTPL. Journal entry case 1 FVTPL. P&L account debit 10,732 to deferred tax liability account 10,732. Okay. Now write down case 2 FVT OCI. Case 2 FVT OCI. Case 2 FVT OCI. Entry will be OCI account debit to deferred tax liability. OCI account debit to deferred tax liability. Because you are going to pass entry for increase in fair value in OCI, so correspondingly the deferred tax liability is also recognized. Okay, now we'll take a break.